Good morning, everyone, and thank you to our for joining our monthly webinar series Beyond the Field. I am your moderator, Amanda McLean, the Farm Management Specialist here with North Dakota Farmers Union. Today's topic, we'll be covering the One Big Beautiful Bill Act, or OBA, a tax provision with Rod Małcheski, principal in the Agribusiness and Cooperative Group, and Jim Hyman, CPA principal in the Ag, Food, and Beverage industry at Clifton Larson Allen LLC. I would also like to have everybody know that NDSU is partnering with NDSU Extension to host two special one-day workshops on succession planning. Our goal is to help family farms shape the future ownership of their family farms or ranches. These workshops will be held January 21st, 2026, 9 to 4 p.m. Mountain Central Time at the Stark-Billings County Extension Office in Dickinson, North Dakota. We will be having one also on February 27th, 2026, from 9 a.m. to 4 p.m. Central Time at the Lake Region State College in Devils Lake. Lunch will be provided. The cost is free to NDFU members, but pre-registration is required. Each person can register by calling the state office or going on to the NDFU membership portal. And if you are not an NDFU member, it costs just $30 to be a member, and then you can join this workshop. A few housekeeping tips before we get started. Everyone is on mute, but if at any time you have any questions or comments, please feel free to type them into the Q&A space that can be found at the bottom of the toolbar in your Zoom window. We will have time for Q&A for Jim and Rod at the end of this presentation. Also, this webinar is being recorded, and you can find this one or previous webinars by searching North Dakota Farmers Union on YouTube. We ask that you also please take the exit survey after the webinar, because this helps to build the content to improve these webinars. With that, I'd like to introduce our two guest speakers today. First, we have Rod Małcheski. As I mentioned, he is the principal in the Agribusiness Food and Beverage Group, specializing in tax, reconstructing, and farm transition and succession planning. He currently serves as the principal in charge of the Agribusiness Midwest region and the principal in charge of production tax for Clifford Larson and Allen LLC, and is a co-founder of the Agribusiness Transition and Succession Practice. Additionally, Rod has a monthly column in the Progressive Farmer magazine and is frequently nationally presenting on regarding farm tax issues. We also have Jim Hyman, who is a tax principal of Agribusiness Food and Beverage Industry at Clifford Larson Allen LLP, specializing in livestock, soybeans, corn, sugar beets, and other grain production. His experience includes tax planning, research, compliance, business consulting, succession planning, estate planning, and being a resource for his clients so they can achieve their long-term goals and objectives. With that, I will turn it over to you, Rod and Jim. Thank you very much.
Awesome. Thank you much, man. Appreciate it. Today we're going to talk about the One Big Beautiful Bill, some 25 changes, strategies that we can talk about. Just kind of give you a 30,000 foot view to kind of familiarize you with what the bill entails for farming. Before we go into that, just wanted to give you the quick little disclaimers and also a little bit about Clifton Larson Allen. We are an accounting firm that specializes in sub-industry. For instance, we have an agribusiness, food and bev sub-industry. We have over 300 people that are dedicated to work with our agribusiness clients. Jim and I work in tax. We also have assurance people that do the audits for farms and grain operations. We have our biz ops, which is our general accounting people who help you with QuickBooks. Then we have a host of other things, such as we were talking cybersecurity. We have a succession team. So pretty much we can help you guys soup to nuts on a lot of your needs from a farming operations standpoint. Like I said, today what we're going to start with is some individual provisions. We're going to go into some of the business provisions. We're going to talk about something you guys probably have been hearing about. There's kind of a little wave going around the industry right now with R&D for farms. Then we're going to finish up a little bit with some succession planning opportunities and also a brief overview. The OBBA also is a mini farm bill, and there's some provisions, non-tax provisions that we wanted to go over as well that probably are some interest to you. So with that, I'm going to let Jim go and start with our individual provisions of the OBBA.
Thanks, Rod. And good morning, everybody. Yeah, like I said, I'm Jim Heilman. So I sit in our office in Mankato, Minnesota, but I really do work with farmers all around the country. So doing a lot of work with year-end planning right now, which I'm sure people on this call are as well. But lots of changes here. And, I'll be honest, there's a lot of these individual provisions that we're just starting to get familiar with as well. Because things that are bringing back into our Schedule A or itemized deductions, some changes there that, a lot of times until we sit down with clients and really go through year-end planning and projections, we don't really uncover some things that they might want to do differently with year-end planning this year. So, very, very important year to meet with your consultants for some planning. So, first thing I want to mention is, with the new tax bill, you'll see the word and hear the word permanent all over the place. And the way I like to phrase that is, nothing is ever permanent. I would say it's temporarily permanent. But the key to having a lot of these new provisions permanent, what we really like about them is there isn't a sunset provision. So if we think back to 2018, when Trump's first Tax Cuts and Jobs Act bill went through, there was an 8-year window on that. So if there wasn't any new tax legislation passed at the end of that 8-year period, everything would revert back to tax legislation under Obama. So it had a clear sunset, and we were sitting here in 2025 wondering if there is any possibility that might hit and we might just revert back. So now that we got things permanent, it really does take new legislation to change. So the part we all like about that is it gives us more opportunity to plan. The tax rates, really, it's just an extension of the Tax Cuts and Jobs Act. And if you do the comparison of, 2018 and then where they are today, adjusted for inflation, the big thing to point out is, all of the brackets dropped a little bit. The top bracket was going to be 39.6, and we're down to 37%. And when we pull in some of the business provisions like the qualified business income deduction, it really potentially takes that federal rate down lower than 30% on some of your business income. But the legislation for the last several years really expanded this middle bucket and brought in some nice tax brackets in that 22 to 24% range, going all the way up to almost $400,000 of taxable income now. So that's the big thing with these tax brackets. It's this middle bucket that really expanded. And with a lot of the farmers we're working with, I mean, we know prices with grains aren't the greatest right now, but with various government payments, we're still seeing a lot of taxable income. So making sure that we're not missing out on these low rates. Personal exemptions continue to be repealed, but the flip side of that is we got the higher standard deduction. There was a slight uptick to the child tax credit. AMT, alternative minimum tax, we really don't see that come into play a whole heck of a lot anymore, but it could a little bit as we move into the ability to now maybe deduct some more state income taxes. And then there's a little change to the Medicare health insurance premium tax credit. Next slide, Rod. So as I said, the standard deduction, what they did back in 2018 is they took away personal exemptions and increased that standard deduction. For 2025, I think the regular number is up to about 31,500 for a married couple. 15,750 for individuals. So we really have a higher standard deduction. And the clients we work with, most of them, because of if you look over to the right, the state and local income tax cap, Prior to this, it was capped at 10,000. So a lot of our farmers, really were taking the standard deduction because, you're deducting your real estate tax on your land on a Schedule F or a Schedule E. Um, if you have a business, S corp or partnership, you should be making state tax payments in the form of the pass-through entity tax payments through the business rather than individual. That's the best way to do it. Um, so we don't see a lot of clients itemizing anymore. But if you're close to that number, some of the discussions we're having right now is, do you look at adding a donor advised fund to bunch up a few years worth of charitable contributions? And really the strategy with our Schedule A's is, can we take our deductions, whether that's personal state income taxes, charitable contributions, and figure out a bunching strategy so we can have 1 year where we push our Schedule A itemized deductions higher, and then really take the standard deduction for a couple of years. So it's kind of the bunching strategy. So it's something to sit down and talk to your CPA about. Um, Higher amounts for seniors that get added to the standard deduction as well. Those are kind of the key individual items we wanted to bring up with. And again, there's other opportunities for deducting some interest expense on vehicles and a lot of other little nuggets in there that would be good to meet with your CPA and just see how much they apply to your particular situation. I'm going to kick it over to Rod to talk about some business provisions.
Perfect. Yeah, I'll just chime in quick too with the premium tax credit. We're all aware the government was shut down and just recently reopened. A lot of that was due to the premium tax credit. Right now, there's an enhanced tax credit. That's what we call the 400% cliff, 400% poverty cliff. That was removed so that overall people would pay more. They wouldn't get the enhanced credits. They'd be paying more for the insurance. And that's something I think probably will end up changing. If not, that's something also our farm clients have to be aware of. For those that are on the Obamacare, there might be some higher premiums because you don't have that enhanced tax credit going forward. So health insurance costs might have gone up for you guys. So just thought it was timely because we have the government shutdown that just ended on the premise that they're going to address this issue. Will they address it? Who knows? But that's something to be aware of. For businesses, they had a couple key provisions in the OBBBA that really have helped out. Under the old law, for business interest limitation, you were limited to 30%, basically taxable income that was adjusted to basically include depreciation and include amortization. Now, if you're a farm and you have debt, that depreciation, that depreciation add back usually gets your income down close to zero. So when you have 30% of zero, there's not a lot of business interest you can take. And so that was a big issue, especially for some of our farms with higher leverage using of debt. So now what they ended up doing is saying the taxable income that the 30% is based off of is now you add back depreciation and amortization. So you start with a higher level or a higher number. So this is going to be a really nice thing for especially people that have a higher debt burden, or for instance, a dairy that had an expansion. You might have bought farmland and you have a high interest payment. So this is a really solid a change to the tax law to allow that, to allow more interest deduction to be taken by our farm clients. Section 199, that's QBI. That has been expanded or extended and also continued with a higher phase out. So more will be subject to QBI. The thing about this one is, and we'll talk about the qualified production property going forward, but QPP, that's that new property, for farms and chemical manufacturers. That will also be included in that 2.5% depreciation calculation. So the QPP could actually help increase the 199A deduction for our farm clients. So again, good thing. Like Jim was saying previously, when you add that can reduce your taxable income significantly, or tax rate significantly, from say 37% down to say like a 28%. So that is a great provision for our farm clients. Bonus depreciation, everyone's really happy about this. I'm sure all of you guys have been feeling the pain of the 80, 60, 40% bonus adjustments. Now, as of 1/19/25, if you have property that was purchased and placed in service after that date, acquired and placed after 1/19/25, it is now back to 100% bonus depreciation. Now, the problem that we're seeing is sometimes, for instance, you have a barn expansion or something, a silo that you signed the agreement in November, December, and it was going to be built in the spring. Because it was not acquired before or after 1/19/2025, that's still 40% bonus depreciation if that's what you choose to use. Same thing with barns or dairy projects. So you have to be very careful about when you sign that contract. If it was signed before 1/19/2025, there's a chance that it's going to be a 40% bonus depreciation, not 100%. So that, again, something to be aware of, especially during planning. You might think that everything is subject to bonus, but if you bought it or signed a contract or acquired it prior to 1/19/2025, it's probably 40%. So again, just be careful about planning so that you're planning with the right numbers. Section 179, that was increased to $2.5 million. So we've got a lot more 179 to work with. The phase out is now $3.1 to $4 million. For the vast majority of our farms, they're going to use 179, not bonus. So even if they're talking about the 40% bonus, hopefully the increase in 179 is going to allow you to take, 179 on the 15 and below assets to help mitigate any circumstance. Or if you bought a piece of equipment January 2nd, January 3rd, you can always take 179 if you're under those limitations. Capital gains deferral. This is an interesting one. So if you sell your farm, the federal government now will allow you to recognize it equally over 4 periods, 4 years. So you can sell a farm for $1 million, and let's say you have zero basis. You can recognize $250,000 this year, $250,000 next year, $250,000 the following year, and finally the $250,000 the end year. However, there's some key things in here that make this probably not usable for the vast majority of people. First, it had to been farmed for the prior 10 years, leased to a farm or actually farmed. So if you are a tenant landlord, if you had leased to an active farmer, that still qualifies. Or if you're an active farmer, that 10-year period. Here's the one that's going to be kind of tricky. When you sell the property, the buyer has to have a covenant or a legal agreement that he will farm the land for 10 years after purchase. In order to qualify for this, you have to attach that legal agreement or covenant to your tax return. So I'm not sure how many buyers are going to voluntarily restrict their use of the farm to purely farming for 10 years in a legal agreement to make this feasible. Now, I think there's probably some situations where it would work, but if I'm a buyer, I would think twice about locking my purchase for 10 years of farming, especially if, for instance, you're in an area where there's some urban sprawl, where some data mines or data centers or solar is coming in and you can get a premium. Now you're locked into farming that land for 10 years, regardless. The other problem is if you're the seller, for instance, if the buyer misses a payment, that triggers automatic recapture or taking all the income in that year. The death of the buyer also triggers instant gain recognition. And also, if there's a sale of the buyer's farm or a liquidation of that farm, that also triggers instant recognition. So there are some caveats there where, again, it sounds good. And in the right circumstances, I believe it's not a bad option. But you got to line all the ducks up in a row to make sure that everything works for you and the buyer. And also you're aware of the risk on the back end where, like I said, if the buyer misses a payment, it's instant recognition of that capital gain. The buyer dies, instant recognition. So you have to be aware of that as well. So bonus depreciation, just going into that again, 100% the property acquired and placed in service after 1/19/25. Ironically, the inauguration date, we didn't want to extend it full year. It only has to be after the inauguration date. Qualified production property. We'll go into that in a little bit in a minute. And 179 again, the $2.5 million increase to 2.5 million. So all positive things there. Some opportunities. Like I said, the bonus depreciation is going to help out this QPP, qualified production property. This is an interesting one. That would be subject to 100% bonus. It's non-residential real property used in manufacturing, production, or refining. Has to be an integral part of the qualified production activity, i.e. farming. Construction has to occur after 1/19/25 and before basically 2029, and placed in service basically by end of 2023, or sorry, 2030. Now, I'll say this is kind of an interesting one, especially for some of our operations that are kind of vertically integrated. The IRS has only put out a few things. The one for agriculture is basically if you catch fish and can it, the canning operation is QPP. That's essentially the extent that we have right now for that operation. So again, one of the things that we have to look at is what is actually going to be QPP property. What is the IRS going to allow? To what extent of post farm is it going to be cheese manufacturing? Is it going to be canning, packing, a packing line? We need to get a little bit more understanding of what actually is going to be QPP property, but at least the IRS has said they will provide guidance at some point to allow us to have a better understanding what that is. But again, for vertically integrated farm operations, like I said, those that might have vegetables and they can them, or they are packaging for sale directly to the consumer. Those are things that we think QPP will apply to, and it becomes basically a 20-year asset versus a 39-year asset subject to bonus. So again, it could be a great benefit for our vertically integrated operations. And so with that, Jim, I think we're going to go to you on the cost seg R&D.
Yep, perfect. So we're going to shift in, spend a little time kind of focused on R&D, and on this topic itself, we could talk for an hour. There's a lot going on here, but I'm going to probably just try to spend about 10 minutes or so just talking about some of the changes with the tax law, and then a little bit more background on R&D credits. So first with, a little bit of background. So R&D credits have been around, forever. I mean, they've been, around for over 20 years. And we've seen them in agriculture, at least in our space, a lot with our livestock producers, a lot with our larger farmers, but really the concept applies to many. It's just getting out a little bit more popular now for a couple of reasons. One is it's this change that came out with the One Big Beautiful Bill. So if we step back to, again, the 2018 Tax Cuts and Jobs Act, R&D credits were there, they were available. If you were doing research activities in years 2018 through 2021, for a farmer, for a cash basis farmer, you're deducting all of those supply expenses, but then you're potentially getting a tax credit on top of that. Now, these tax credits can be anywhere from 7% to, I think they can go as high as 14%. Generally, we see them closer to that 7 to 8% window. But from 2018 to 2021, if you were doing research, you would deduct those expenses and potentially change some credits. As part of the Tax Cuts and Jobs Act, there were some revenue raisers in that bill that would kick in towards the end of that 8-year window. One of them was the bonus depreciation changes. That's why we went from 100% expensing to 80% to 60 to 40. There had to be some revenue raisers at the end to make up for some of the cuts. Same thing with this research expenses. The original bill said in 2022 for those taxpayers, businesses that are doing research activities, rather than currently deducting those expenses, you're required to capitalize them and amortize them over a 5-year period. So for a lot of our clients that were doing research, that were claiming tax credits in years 2022, 23, and 24, even when they were claiming credits, they were probably going backwards on the tax return because they were required to capitalize those expenses and spread them out over a 5-year period. So this was one of those provisions that nobody ever thought would make it, that there'd be a change. And even in years 22, 23, 24, we were expecting Congress to jump in and maybe reverse that, but they didn't. So we still had these capitalized expenses over a 3-year period. So it was pretty quiet with companies that promote R&D studies and a lot of CPA firms, just because if you went after these credits, you're probably going backwards on the tax return. So the tax cut, or excuse me, the new tax bill reversed all of that and made it retroactive. So depending on the size of the company, if you were one that was capitalizing research expenses along the way, there's opportunities to recoup those expenses on this year's tax return and free those things up. And more importantly, it kind of brings us back into the spot we used to be in pre-2022, where we can deduct our expenses and potentially change and potentially get some R&D credits. You can go to the next slide, Rod. So let's jump into a little bit overview again of the tax credits. It's a tax credit, so it's not a deduction. So it's a dollar for dollar reduction in taxes due. However, and this is the important part, if you have any companies talking to you about R&D credits, there are several howevers when you go down this path. First one is, yes, it is a tax credit that offsets tax, but if you get through all the steps where you're able to claim credits, the first hoop you got to jump through is that business needs to be profitable. It's not going to be like a PPP money or ERC money or anything like that where they just send you a check. First step is whatever business or farming entity that is, we have to be showing taxable income. And a lot of farms we work with, of course, with our year-end planning, we're deferring income, we're prepaying inputs, we're depreciating equipment, we're probably dragging that taxable income number down fairly low. So even if you're claiming tax credits, you might run into a situation where they're just going to carry over and they're not going to be utilized. Still doesn't mean you don't want to explore and go after it. It just means you might have to do something differently with your tax planning strategies to benefit from these credits. And again, typically 7 to 10% range. I think my history shows it usually comes in somewhere in that 7 to 8% of those qualifying costs. We'll talk a little bit more about the qualifying costs in a little bit here. Credits that are not allowed to be claimed in that first year do carry forward for 20 years. You do have an opportunity for carry back years as well. And the other thing we're looking at, if you haven't done R&D credits in the past, and you're going to start looking at it right now, we really want to go back and explore when those credits first, when the activity started, because maybe it's worth amending some returns in the past to get some credits carrying over into the future. There is an opportunity for offsetting some of your payroll taxes with these tax credits, but I don't see that a lot in the farm space. It's usually startup tech companies, those types of things that fall into that category. And I'm not sure what North Dakota has for R&D credits. I think they have some. I'm not that well versed in them, but I know Minnesota has some. There are some state tax credits, but what we're talking about here mainly are the federal credits. You can go to the next slide, Rod. So the 4-part test, again, this has been around forever, and the foundation for claiming research. And the couple of these boxes are pretty easy to check. It's got to be there's got to be a business purpose to what you're doing. It has to be technological in nature, grounded by sciences. And obviously in our farming world, we got agronomy, we got biology, we got sciences. So the first two boxes are pretty easy to check. It's the next two where you got is elimination of uncertainty and the process of experimentation. So a lot of people trip up on this one where they think they just don't qualify because it's they're not bringing something new to to the market. They're not the first ones to do it, but you don't have to be the first. You don't have to be the first farmer to change a hybrid in your field because you're relying on that seed company that's saying that their yields are going to be better. They're gonna be a shorter growing cycle. It's going to be a different crop that you're raising. You don't have to be the first to do it. There just has to be some element of uncertainty, and there has to be some process for experimenting with those different things. So a lot of the things with our row crop farms we're looking at right now are some of those things. Does changing a seed variety qualify? Does some of the things that come up pretty common in these conversations, if they're changing, management practices, strip tilling, are they doing different things where backing off nitrogen and using different types of products, biologicals, those types of things? Are they switching over to variable rate planting, spraying? If you think about any farm operation today, we're always trying to get better. We're always trying to improve on our process. We're always trying to, be that low cost provider, look at ways to become more efficient, um, increase production, um, increase profitability, of course. And, there's so many types of research activities that are going on. It's just a matter of identifying those activities and seeing how they apply to the tax credits. Go to the next slide, Rod. So when we do these scoping calls with clients, a lot of times the way we start them, first off, if you're interested in any conversations with R&D, my contact information's at the end. We got a team that specializes just in R&D, and we'd start with the scoping process. Uh, Before I go into the two different avenues here, I'm going to expand on one more reason we're looking at this a little bit more right now. We had the change with the new tax bill, and there's also a court case going on right now. Now, it's not final, it's still in the process, but it's one that would really change the landscape for R&D credits in agriculture. Because for the longest time, there's been a court case that goes back 30, 40 years really to a manufacturer basically making a widget that doesn't really cross over into agriculture quite that well. There's a current case that is on its way to court. I don't exactly recall where it's at, but it relates to a tomato grower. And what they've been trying to say is, the product, the tomato they're bringing to market, they're changing things with variety, they're changing things with planting process. They're doing things to bring a less acidic tomato to the market. They're bringing things to bring a riper, larger, more attractive tomato to the market. They're really changing that end product of what is going to the market. And when we take a step back and we look at these credits and how we can really get some large credits, that's a key distinction because there's two different paths you can go down. If you look on the left-hand column, it's this newer, improved product. So let's say we're following that tomato grower and we're saying, you know what, we're raising a tomato that's going to be better for the market. It's really a new product we're bringing to the market. Then what we can potentially include, and I say potentially because there's a lot of subjectivity and gray in this area, but what we can potentially count as our qualifying research expenses are seed costs, fertilizer costs, a lot of our input costs, and maybe not all of them, but a large portion of them. And the big thing there is obviously that's our base for calculating that 7 to 8% tax credit. And we're still deducting all those expenses, but if we can capture a lot of our input costs and get a 7 to 8% tax credit on top of that, that's huge. But we have to be down this path where we're saying that it's a newer, improved product we're bringing to market. If we go over to the right-hand column, the newer improved process, I would say almost every farmer out there is changing their processes on an annual basis and doing research that would qualify for tax credits under this newer improved process. But under the process bucket, you don't get the whole supply cost. What you would look at if you can't get to the point where you're bringing a new product to market and you're really just changing your process, there's credits that qualify, but you look at, okay, here's what our input costs were last year. We changed some practices. We, got some different seeds. We got some different fertilizers. We got some things that might have cost a little bit more. Our cost of production went up this much. So it's really this difference between the two that qualify for that tax credit. So much smaller tax credit under the process change versus the product change, and what we typically see, I mean, it's almost like a 10x factor, if you just think about when you're able to deduct, or excuse me, claim credits on all of your research expenses. But we're really hoping that court case gets to a conclusion so we have some better foundation to go off of. But right now it is, I would say, still quite gray and quite subjective. But those are the two different pathways we can go down when it talks about research and development tax credits. And I think there was at least one question that popped up. Have you ever been audited on a farmer claiming R&D credits? And yes, I mean they do get audited, that is for sure. So if you're working with CLA, we our R&D study is quite intense. We go through a full process to make sure we have everything documented, make sure we have everything identified. So if audit comes, we have the documentation to support that. And what I would caution people about is because we've seen companies that go out and promote these credits pretty hard and they hit the pork industry heavy, I would say from 2015 through 2022, and there's still a lot of credits being claimed, and there's still a lot of validity to the credits that are being claimed. But it's at some point unless you continue to evolve and continue to make changes, at some point your research really stops and it goes into the commercial process of what you're trying to do. We've seen studies where that they don't stop that. They look at the entire farm and say, okay, everything we do is creating a new product. Everything we do is creating research credits or research activities that generate credits. And I think it's tough to just look at that on the face and really believe that's true. So it's dissecting the business, making sure that you are looking at just separating research activities from your true, call it normal production, claiming credits on the research piece and not going too crazy on this because we do see these flagged. Once credits get a certain amount, the IRS loves to audit those. So you want to make sure that you're going through a good full-blown study and you truly understand, you truly understand the risks that you're taking. One, understand the risks, but then I would say more important, not more importantly, but as important, your ability to use those credits. Because I've worked with clients that they went with a different company and they come in with this research study that they paid $50,000 for and generated $500,000 of tax credits, and they think they're going to get this big check. Reality is we're still carrying over credits because we probably haven't even generated enough income or some of the other limitations to be able to utilize those credits. So a lot of hidden traps here. Again, if it's something you want to talk more about, or if it's something, maybe in a later series, I could bring somebody from our R&D team to, go specifically on that. So I went on a little long with R&D, but I think it's important that I'm guessing a lot of farmers out there right now are being contacted by companies doing R&D studies. It is a pretty hot button out there, so that's why I wanted to spend a lot of time on it.
Awesome.
Rod, back to you.
Perfect. Yeah, and I'll give a shout out to Jim. Jim's leading the R&D for agribusiness in our firm, and the one thing I appreciate about our firm is that unlike a lot of companies that just see a dollar sign and a percent of the credit collected and they'll disappear in 2 years. Jim has put a lot of time into this to make sure that this is a legitimate qualifying, thing, and he knows his stuff. So again, appreciate it, Jim. That's a great summary and an understanding of the situation. So again, kudos to Jim. Just going to go over quickly some of the estate stuff. Under the OBBBA, we've increased the estate and gift exemption to $15 million for 2026, indexed to inflation. That's a small adjustment from 25 to 26. And then some states lower. North Dakota does not have any sales or gift exemptions. We don't have to worry about that. But on an estate side, it doesn't take much now for a lot of our farm operations to butt against that 15 million, 30 married filing joint. And so, our thought is that estate planning isn't death planning. Estate planning is succession planning, where we're looking at where you're at in your farming career, what your end goal is going to be. Is it kids? Is it going to be a sale? And we're planning for that along the way. And as Jim says, was saying, a lot of our farms really are more, they'd rather pay zero tax than position themselves for maybe a future succession or benefit. And so that's where, for succession planning for our farm clients, I think you need to know where you're going to go and have a long enough runway to get there so that it's the most tax efficient and also the best thing for you and your family. A lot of our farms now are Schedule Fs or partnerships. We have succession of the next generation coming in. We have all the fair and equal arguments of heirs that are farm and non-farm. And again, these are things that, in my opinion, are some of the more complex things in farming. We can say tax and accounting and all this, but people have the hardest time trying to figure out how to transition the farm to the next generation, how to make it fair for the siblings, how to make it fair for the incoming child into the farm. And again, that's where, estate planning is kind of the default, succession planning where it's at. And Jim, you can chime in too, but a lot of times now when I tell my clients, if you have a son or daughter coming into the operation, it's probably a good time to get a valuation. And that allows the farm family to understand from the time the son or daughter comes in the operation to the time mom and dad either transition or pass away, what the real value that son or daughter has given to the operation, the value, the growth of it. And a lot of times, my opinion, that growth goes to the son or daughter, the one that was in the operation. Maybe you could say if the farm started at $1 million but grew to a $5 million farm, that first $1 million might be subject to the fair and equal argument, but that next $4 million was through sweat equity. And it's really having that identifier, quantifiable, measure to show what that son or daughter had put into the farm is really key. Like I said, too, is also transitioning it so that we don't have to rely on any state exclusion. that we can transition the farm smoothly over a period of times, profit sharing, gifting strategies, estate freeze techniques. And again, I just implore you that if you are going through this or thinking about it, the best transitions are a small, series of smaller baby steps to get to an ultimate goal versus either avoiding it altogether or waiting for one large transition. Jim, any thoughts on that?
Yeah, I mean, I agree with that. This is so the of the hot topics with clients. I mean, this with the farm clients I work with, this is probably number one because my biggest concern with the new tax bill, you know, it's of course this is permanent and people are going to let this sit for throughout Trump's administration. And then who knows what's going to happen again? Who knows what the next administration is going to do? Transfer taxes, of course, are something that the government likes to get their hands on. And why not take these next 4 years, do the right level of planning that makes sense for the farm, for the family, and get things set up for the future. There's a lot of things depending on estate size, that if let's just say you're in a federal taxable estate situation, we currently have a lot of tools we can use with discounting from business valuations, with using various irrevocable trusts to freeze estates, with a lot of advanced estate planning tools that are in the toolbox right now. Again, who knows 4 years from now if that will be the case? Every time you see potential changes in this space from various sides of the government, they talk about going after the use of some of these trusts, going after um, valuation discounts, going after those things. Uh, don't let this sit and wait 4 years. Do the right thing now. That's the perfect thing for the family, for the business in the future.
Exactly. Yeah, bury your head and usually you regret it. It's again the progression of, and I was just talking to a family about this. If you don't start today, you're going to look back 5 years and regret it. But if you did start today, you're going to look back 5 years and say, how far have we come? And so again, that's where and we know it's very difficult to transition the farm, just the thought process of giving up ownership, giving up control. But again, it's something that I'd rather see our clients take the baby steps and continuous progress, because over time that does add up and makes it a lot easier. But doing nothing typically is the worst case scenario and usually the worst result for the family. Final thing we wanted to just briefly touch upon is, as I mentioned, the OBBBA is quasi mini farm bill. And some of the things that I just wanted to bring out, is the ARC payment went from 86 to guarantees up from 86 to 90%. The maximum payout is 10 to now 12%. For those that don't have base acres, they're going to open up 30 more million of acres that don't currently have the base acres. So that's going to be a great benefit there to those who are short on the base acres. Higher reference prices, so that means you're going to get higher payments from ARC PLCs. For dairies, the DMP, this goes to 6 million from 5 million on the tier 1 and 2 milk. So again, all great things. Some of the ones that really excite us is that payment limitation increase from 125 to 155. That is great. We're going to get more government payments, not have to worry about those restrictions as much. The next one is the one that Jim and I really just started drilling about. We've been waiting for this, I don't know, 15 years maybe. LLCs and S Corps now are basically treated as general partnerships for payment limitations. So before, you would have one payment limitation at the LLC or S Corp level, regardless of how many owners. Right now, that is now disregarded. So it goes down to the ownership level. So we don't have that entity block, so to speak. Now, many of our clients were either Schedule Fs or general partnerships because of this. The problem with a general partnership, it opens up all assets to lawsuit or liability. Now we can start looking at forming LLCs or S corps as appropriate, because we don't have to worry about that. That will provide liability protection while at the same time still creating the maximum payment exclusions. So again, I saw this, and basically these are the clients that we've been waiting for years to restructure or put them in a better liability protection situation. All those floodgates have opened now, and again, it's a great time to have that conversation with your tax or professional or attorney, to try to really understand how that impacts you, how it can mitigate your risk. And as Jim has also said, if you form an entity, an LLC or S corp, now you got discounts. So if we do transitioning, now we can form an entity that allows us to maximize the discounting and reducing the gift or estate exemptions. So again, all that stuff has been great. Final one is I've been getting a lot of clients now with the phone calls from solar providers. The solar projects are going to come to an end in 2026. So you're getting a rash of people trying to get that last minute solar projects off the ground. So again, if you are looking at a solar project of your own, or maybe leasing or renting land out to a solar, a private equity solar project, remember those projects are set to expire essentially July of 2026. So either don't drag your feet, or on the flip side, you probably have a little more leverage now against those solar companies to maybe get a little better pricing rates or increases, especially if your land is one of those prime lands by where they need it. So again, something to think about. All great changes to the farm. I don't know, solar is up for debate if it's a great change or not, but for the rest of it, like I said, everything was positive for farms. Kind of some quick year-end tax planning. One, talk to your advisor. Even people that have losses, there's always opportunities in loss years as well. So just because you have a loss doesn't mean that there's not tax planning. Get your estate in order. Like I said, Jim and I said, don't avoid that. It's good to at least examine it or have the thought or discussion around it. Explore the R&D credit. Think about that. What do you do? Is there opportunities there? Residual fertilizer. We won't go into that today, but that's something where I strongly recommend anyone that has done or considering it, vet that out very, very carefully so that you know what you're getting when you go into it. The bonus 179 changes are a great thing to think about. Remember, you don't want to be caught thinking you have 100% bonus when in actual it's a 40%. So pay attention to those dates. Of course, always using deferred payment contracts are great to spread income either in current year or next year. Allows you some flexibility. As Jim was also saying with QBI and all that, there's some planning around QBI, either if it's passed through a co-op, or you have generating your own QBI. There's a lot of times where you do want income to maximize the QBI deductions and the impact to you. Consider retirement accounts. I think I speak for Jim is over the years, my thoughts on retirement has kind of changed a little bit. I love when parents pay their kids a wage, put it into a Roth IRA. I have a little spreadsheet I send my kids almost monthly now about how if you're, I think it was at age 10, if you put $5,000 away, by the time you're 65, it's $1 million. So you might not consider, it's a lot of money, whatever it is, but if you gave your child a wage for doing some on-farm work, put it into a Roth IRA, by the time they hit retirement age, they could have multi-millions of dollars from just small incremental additions to their Roth accounts. So again, great thing. Other than that, really, it's just be proactive. There's a lot of changes here, a lot of things that you probably haven't read about or understand. It's always good to just go into your tax professional just for an update. Kind of check under the hood to make sure that everything is where it should be, that you're maximizing all the new tax law changes, that you're receiving all the benefits that are available to you. So those are kind of the things that we wanted to throw out there for year-end planning ideas. I believe there was some questions as well, Jim, so we can answer some of those. Or Amanda, was there some questions?
Yes, there was. And I know, Jim, you answered the first one. So I have not been through a situation where a client where they have been audited and the credit completely thrown out, but we have seen instances under audits where they throw out certain research activities and curve back the credit amount. Doesn't mean it can't be completely thrown out, but in other areas where there's abuse, which usually triggers future audit activities. Oh, Jim, did you?
Yep.
Never mind. That was
Yep,
Jim's
yep,
advice.
yep. That was my response to, audit activity we've seen in R&D. And again, I haven't been in a situation where they've been completely thrown out. It would need to be, obviously where there's no research or almost a fraudulent type situation, but we certainly see them where they get carved back. And there certainly can be penalties based on the amount of credits and the amount of taxes that are being saved. But because this is one of those abuse areas. It is one that's on the IRS radar for audit activity.
Yeah. And I always tell people, if they tell you these numbers that are too good to be true, usually they're not true.
Mhm.
And that's the stuff that gets in trouble. I always tell people, if you can always sit in front of an IRS agent and with a straight face explain why you did what you did, you're fine. But a lot of times, some of these companies will be so overly aggressive that I don't know how you can defend those positions. And that's, I think, where the abuse and residual fertilizer as well and other things. It's the people that push the boundary to an extreme that get in trouble.
Yeah. And the burden of proof is on the taxpayer, not the IRS. You always got to remember that. So the way the IRS audit process goes, you get an agent, they deny a portion of it, you send it to their appeals officer. Their appeals officer is going to support them, and your only way to basically get something reversed is taking it all the way to tax court, which is not going to happen. So make sure you're comfortable with positions that are being claimed on your tax returns.
Thanks. Again, if you have any questions, feel free to type them into the chat or Q&A. I have also unmuted everybody. If you prefer to ask directly, you just have to mute your microphones. But I do have a question for you both. So now with the changes, with the limitations on the LLC and the S corporation, what would be the better tax advantage choosing between those two business structures? If a person was in a general partnership and wanted to go to one of those, how do you know what would be the better one to choose?
I personally like LLCs as a default, unless there's a specific reason. The problem with people, you'll have different arguments. The S corp, you'll have to pay yourself a wage, but anything on top of that is not subject to self-employment. Whereas typically in an LLC, everything is subject to self-employment. However, there's detriments. The S corp, debt does not add to basis. So a lot of times we see losses that are suspended in an S corp, whereas in a partnership, debt adds to basis. So those losses would be allowed. So, it's kind of one's got a benefit, but it also has a corresponding detriment and vice versa. So I'd say the default is typically getting an LLC, but also then looking at your specific situation and determining, what really is the best entity. But I'd say 7 to 8 times out of 10, it's going to be the LLC. And then, like I said, higher income farms that can't control income as much, maybe it is the S corp. With that caveat too, never place land in an S corp. Always make sure that if you do go with an S corp, you are going to have a separate LLC for land holdings. It's almost impossible to get land out of an S corp at some point. So again, my caveats: even if you go with an S corp for the farming op, keep land in an LLC.
Mm-hmm. I'd agree with Rod. I like LLCs, LLPs, taxed as partnerships versus S corps if you can manage self-employment tax. You also get the base. So somebody passes away, there's ownership changes, you get basis step ups in the underlying assets, not just the stock like you would in an S corp or a C corp. So I think they're easier vehicles to transition. Not going to say easier, more favorable vehicles to transition.
Okay, another question. I know it kind of reflected on your last slide that you had there, Jim. Could you expand on the 179 deduction not requiring equipment purchases?
That's the second time that I got to change that in the slides.
Yeah.
Okay, I got to rephrase that. Basically, it's the old comment that you probably get from your CPA, or you hopefully do. Don't buy equipment based on need. Or excuse me, just for tax purposes, buy it based on need. We got the ability to expense everything. This is the second time that question's come up in presentation, so I'm going to reword that. We can expense anything 179 up to 2.5 bonus, no limit on that. And I think North Dakota allows bonus, so you're in good shape. I got to rephrase that. Just still buy based on need, not just for tax motive.
Perfect. From a tax planning purposes, is it better to hold on to the land um, after I die or sell it beforehand?
Well, that
Or
depends.
yeah. Well, the thing too is now if you're looking at inheritance, you'd probably, and we don't have an issue with the 15 million. You probably do want to step up in basis. If there's financial needs where you're selling it pre-death or not dependent on inheritance, I mean, you got to balance the capital gains, the basis of it, and quite honestly, too, there's also 1031 exchanges now and various other techniques that can do tax deferrals on the sale of land, op zones. So I think it's not an easy question. It's going to be more dependent on the specific circumstance. But I think with enough time, with enough creativity, you can always accomplish what you're trying to get at. But really, it's going to be a circumstance or a case by case situation of what the best result or best answer is. So,
Okay.
Jimmy,
Jim,
Yeah,
do
I
you have
agree.
anything to
I
add?
work with one. I got one instance where next generation doesn't farm and they actually really want to have the ability to potential sell. So they're going to hang on to that for the basis step up.
Perfect. Well, it is 11 o'clock, and so to be courteous of everybody's time, we will end today's webinar. Again, thank you, Jim and Rob, for your time. If anybody has any questions for them, I will be sharing this presentation and your guys' contact information for follow-up. Again, this recording is, you can find it on our YouTube channel. You can also find our previous one. So this goes really great with the estate planning one that we had in October, along with the Farm Bill update that we had in September. So go back to those if you have questions or want to rewatch those. Again, be on the lookout for our webinars. We will not be having one in December just due to the holidays, but check us back out in January. So with that, I thank everybody for joining us and thank you, Jim and Rod. Appreciate it. Have a good day.
Oh.
thanks.
Bye.